This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home. That's why I go beyond the transaction to share my tips, insights, and advice for adulting made simple. So, we are continuing on. We just finished up rolling one amazing podcast that was all about the big, beautiful bill. And because there's so much to talk about, my amazing guest today, we decided to keep rolling and go even a little deeper. So, I have an amazing guest with me, Jan Pacenta. We're going to talk a little bit more about her in a minute. But what we are going to be talking about today is bonus depreciation. So, I want to be very clear this is not for the basic homeowner. This is for someone who is investing in real estate. It is very targeted. If you ever plan to be an investor, though, this episode may also be for you. So don't just tune us out. If you ever want to be an investor, please stay tuned because you're definitely going to want to listen to this. So, welcome to the show again, Jan. Thank you for staying and recording another episode with me.
Thank you so much for having me. I've enjoyed it.
Perfect. So, those who didn't listen to the last episode about the big, beautiful bill, which you killed it on, let's talk a little bit about who you are so that they know and how to find you.
I'm born and raised in Pensacola and live in Gulf Breeze. I have a husband and two children. I've been very active in community involvement over the years, which has brought me the greatest joy. I've started out with Junior League. I was Pensacola Little Theater, Council on the Aging. I was a board member and treasurer of Impact 100 for 4 years, as well as numerous other things along with my church.
And what do you do for a living?
I'm a CPA,
Where at?
Brown Thornton Bacenta, a
Yes.
partner and owner in that.
And you are my personal CPA, my trusted advisor, and who I call for all major purchases before I do any of them. So thank you so much for being on the show with us and sharing your knowledge. We appreciate it so much. So, all right, we're going to dig into this huge thing, huge topic, bonus depreciation. So, can you explain bonus depreciation like I'm 5 years old?
Bonus depreciation allows businesses to write up a large portion of their assets. It allows businesses and investors. So, say you purchase a $150,000 equipment truck, you can immediately write that off. Or say an investor, buys a new property and has a cost segregation study that breaks that into different panels, such as flooring, fixtures, etc. You can write those portions of the assets 100% off in the first year.
So, what's the difference in bonus depreciation and regular depreciation? Because we've always had depreciation.
Bonus depreciation is 80% deduction up front. So you write it off in the first year. Whereas if you bought that equipment, truck, etc., under normal depreciation rules, you'd have to write that off over 5 or 7 years. So depreciation allows you a tax deduction up front. So it increases your cash flow and it helps investors and businesses buy more assets and help stimulate and grow the economy.
So let's a little bit about real estate investors
Okay.
specifically, because this benefits really all business owners and real estate
Right.
investors, but a huge portion of it does benefit real estate investors. So why does bonus depreciation become such a major wealth building tool for real estate investors?
Because they, as I said, they get the depreciation deduction up front. So say you have a business, a real estate venture that cash flows, you can take the bonus depreciation and actually have a tax loss. That tax loss can offset your W-2s and other income, and therefore your taxes are lower. So when you pay lower taxes, you have more money to invest in other business entities, more properties, more equipment, etc. This bill stimulates the economy.
So how does that actually reduce my taxable income?
A simple rate. Let's say you're a real estate professional and you own a
Hang on, let's classify what a real estate
okay,
professional is.
okay.
Does that mean I have to have my real estate license?
No,
So what is a real estate professional?
a real estate professional is somebody that spends more than 750 hours in real estate leasing, etc., managing your rentals, doing repairs on your rentals, etc. You have to document that, and it can't be more than 50% of your income. So, say you have real estate income, etc., of 100,000, but your W-2 is 800,000. You cannot be a real estate professional because you have a big W-2 to offset it.
But if you were a investor who doesn't have that big W-2 and you do have rental properties that you spend, is it 750 hours a year?
750 hours a year, and it can be split by husband and wife.
Oh,
So if the wife does it and doesn't have a job, she can be the real estate professional, Or and let's say she has 500 hours and the husband puts in 250, combined, they could be the real estate professional.
So, like, if my husband does the repairs on the rentals and I do the research on the rentals, even though I have a real estate license, I'm
Right.
classified as a real estate
Yeah,
professional.
correct.
But people who don't have a real estate license that were in the same boat as us, investing prior to me getting into real estate, they would now qualify as a real estate investor for
They
these
would, and
deductions.
that what that does is that transforms your real estate deduction as active. Normally, a real estate transaction is called a passive property, and you can only offset passive income with passive losses. So
Explain what you mean by passive.
passive means it's a basically real estate by itself is a passive property. Let's say you got a condo that's generating cash flow income of $10,000 a year. Your depreciation on your condo is 25,000. You have a $15,000 passive loss. If you're not a real estate professional, this passive loss can only be used to offset passive income.
So, in other words, I don't have enough income to take that loss.
Correct. And this you can deduct up to $25,000 of passive losses per year if your income is under 150,000. Individuals that have their adjusted gross income over 150,000, they cannot deduct any of that passive loss. That passive loss continues to carry over, and usually people can deduct it when they sell the property and they have a gain, and they can deduct the passive loss there. But for many years, it's stuck on your tax return and not providing any tax benefit.
So, how can you create these losses on paper even when someone is making money in real life?
These losses on paper are due to depreciation. For example, you bought a new condo and in the first year it's cash flowing $100,000. Your bonus depreciation may be 200,000. And so your net effect would be $100,000 loss that you can deduct.
Perfect. So I've seen this work in real life here recently as I've been helping some investors, and it's sort of crazy. One of the small areas that I've seen it work really well is when you have a W 2 employee that is making, let's say, a million plus, 800,000 plus, something like that. They don't have a lot of deductions.
Right, right.
They pay a lot in taxes,
Yeah.
but they don't have a lot of deductions. And so we were able to help them buy a condo. And so let's say we buy a condo that's producing, let's say a $1.2 million condo
Mm.
producing 120,000 a year in rental income.
Right.
So it's making money, but this person is paying so much in taxes, they were able to use the bonus depreciation and reduce their tax liability where that condo was actually losing them $4,000 net income a year. So the cost of the mortgage and maintenance and everything on the condo, they were actually losing $4,000 a year on the condo. But once we applied that bonus depreciation through their taxes, all of a sudden, the amount of money they invested into the unit, the 20% that they put, 20 or 30%, I can't remember how much it was, that they put into the unit, they actually got so much more than that back in the tax deduction of what they owed that year that they were able to make about 158% return on investment that year. How amazing is that?
That is great. A misconception and something we gotta do. The bonus depreciation is for equipment, etc. For purchases of real estate, you really need to get what's called a cost
Yes.
segregation study. And what this cost segregation study does, let's say you buy the $800,000 condo, and what happens is you hire an engineer. There are firms that do cost segregation studies. You hire one of these firms and they come out and look at things, and then they provide the CPA a report that says of your $800,000 condo purchase, 20% is fixtures and buildings, 15% is the flooring, etc. And those items, you can write those 80% of those off up front for bonus depreciation.
So, how much should a cost segregation cost? What's the average on that? I know every firm's going to be a little different.
In this market, I'm seeing 3,000 to 15,000. So it depends
It's
on
a huge range.
yes, but the 3,000, I've had several clients recently that bought or built constructed their office buildings, and those were roughly 3,000. If you're talking about a large building, multifamily build, yeah, et cetera, that's where they get into how detailed the study is.
So I had someone reach out to me and I told them about this and they were a client, they bought and then they were trying to get their cost segregation done. They reached out and said it was like 10 grand. I'm like, it's condo.
Yeah.
That should not be that. Let's
Right.
find you someone else. And
And I
luckily we were able to.
Right, and actually on the research, when I researched this, it said 5 to 15,000. I'm just saying the Pensacola market is not seeing that.
Yeah, we're a lot less here.
Yeah.
So, what type of properties qualify for bonus depreciation? So, we know about equipment for businesses, but then what type of properties? Because there is some difference between short term rental, long term rental.
Right.
Explain that.
Like your short-term rentals are your Airbnbs, your VRBOs, the things that the traditional guest is going to say 7 days or less. Those are considered active properties, and those qualify for the bonus depreciation. And they also, but they're considered income, and a loss from those will offset your W-2 income. The other properties we talked about are longer term rentals, and such as you get a monthly lease and it's for 12 months.
Mhm.
These properties are considered passive properties, and as I stated above, passive losses can only be used to offset passive income. These are limited a lot more.
I'm considered a real estate professional,
If
though.
if you're considered a real estate professional, you're active and you can treat those.
So,
So
if I have a real estate license, or if I don't have a real estate license, but I spend at least 750 hours a year working on my investment properties, whether that's doing repairs, researching for new properties, then I can classify without a real estate license as a real estate professional. It becomes active income. I can take bonus depreciation and take active losses. Is that correct?
correct. The most important thing a individual can do is create logs because under audit, the IRS is going to want to see our logs. How many hours did you spend on this? How many hours of this? You mentioned one spouse making over $1 million. The other spouse could be the real estate professional, and as long as she spends the 750 hours, they can deduct those losses against his W-2 income, partnership income, etc.
And the key is don't lie, actually do the work.
Right.
And the realness behind is you probably are. If you buy a long-term investment unit, whether it's a single family or condo or townhouse, and you are going to renovate it, you're going to research paint, you're going to research flooring, you're going to figure out everything, manage contractors to get it up to to the status you want it. And then you're probably going to interview different rental management companies and the engagement back and forth with them, approving tenants, and then the maintenance that needs to be done, whether you're approving that, ordering it from another contractor. There's a lot of work that goes into it, but the key there is you've got to document what you're doing.
Exactly. You need to document that. You also need to have mileage logs. When you go, if you're part of you can deduct mileage. So if you go to the hardware store to look at paint chips, go to the contractor, etc., you're driving a lot and those are business miles.
Oh yeah, mileage. I've totally forgot about that. The time in the car. Good tip there. So the rules that people get wrong. What are the most common misconceptions or mistakes people make on bonus depreciation?
One of the biggest mistakes people make on depreciation period is they don't take account for land. You cannot depreciate land. In addition, if that condo that we talked about that was 800,000, let's say 80,000 is for the land, and then we split the remaining value of the property into long-term assets, which are depreciated for 31 and a half years if it's a personal rental, versus the flooring, the components, the fixtures, those can be deducted first year bonus depreciation. So you get 100% deduction in the first year.
And that is so important because I think that is the biggest
Yeah.
misconception people hear is they hear 100% bonus depreciation and they think, oh, I spend $500,000 in this or $300,000 in this investment property and I get to take $300,000 the first year. That is not the case.
That's not, and let me correct that because I misspoke a couple of times. It's 80% in 2026. 80%. It was 100% in 2024.
And so 26, which is when this will actually air, it is going to be
80%.
What does it go to in 2027?
It's still 80%. This is one of the things we want people to act now because we think these bonus depreciation phase outs are going to decrease over the years. So it may be 70% 1 year, and in 5 years, they're supposed to sunset. So there may not be no bonus
So
depreciation.
call me to buy investment property ASAP. That's the goal
That's
here,
correct.
right?
You need to do careful planning and you need to act now to take advantage of the bonus depreciation.
And that's one thing I get a lot of people that come to me and they say, especially again, W-2 employees, hey, my CPA says I need to buy real estate. I'm like, okay, what are we trying to achieve? I don't know. My CPA just says buy real estate. And I'm always like, let me talk to your CPA.
Exactly.
I need to know what the goal is here. Are we looking to try and write off? I don't want to sell them a property more than they can write off. I need to know what the strategy is here and the goal. So if your CPA tells you go buy property, say, okay, what am I trying to achieve? So I can tell Jessica, or you may need another CPA called Jan.
Misconception everybody has is they buy multiple real estate properties and then they can't afford the mortgage.
Yeah.
Make sure that you can cash flow or come close to cash flowing the property. You don't want a property that is generating $25,000 of cash flow losses and then put another $20,000 of appreciation. So you've got 45,000 of losses, but it's a passive property. So you can't deduct any of that in the current year.
So let me ask you this, with the exception of my income limits, right?
Right.
So I'm an active, whether it's short term or I'm a real estate investor. So I'm spending like 750 hours a year. So I'm considered active. How many properties can I buy in 1 year? Except for the limits of my income. Obviously, I can't deduct more than I make. So, is there a number of properties?
It's just a bonus to appreciation and it's actually $1.5 million. So
Up to 1.5 million. So if I had enough income to buy
okay.
1.5 million, I could. So you're always going to be though capped at that income limit. You
Right.
can't deduct more than you make.
Right. And the biggest thing I tell investors, a lot of people say, well, real estate's going up, et cetera. I'm scared of the market. Make sure you can cash flow it and make sure that the rental income and the rental losses a lot of people don't take into account all the expenses. They
Yes.
forget the condo association dues, they forget
The
the
maintenance.
the property manage, if you own real estate, you're going to have to keep it up.
Yes. And that, I will say that we try and make sure all of our clients' rentals cash flow, with the exception of beach property. And that is something that is so different with waterfront property.
Right.
And the reason for it is waterfront property is a scarcity. They're not making any more dirt
No.
and they're not making any more waterfront dirt.
Right.
So it's something that continues to go up in value. We make sure our clients understand, hey, look, while this may be helping you on your taxes this year, this house is a house or condo, you're losing 10 grand a year on it, but your family's getting to enjoy it and all that. And when you go to sell it, is when that equity comes out. That's when you're really making money on these waterfront condos
Exactly.
and waterfront homes. And that's very different than what we tell people when they're buying stuff in town, not waterfront. And so when I have an investor who owns a lot of a long-term rental in town and they go to buy something on the beach, the first thing I have to do is, okay, let's have a strategy meeting. Let me make sure you understand because it's not going
Right.
to cash flow
No,
$500 to $1,000
no.
a month. It's
I've
not
been
going to happen.
I've been doing this a long time, and the rules changed in 2005. Before that, you could have losses on these things. So these doctors, et cetera, with the $1 million income, were taking available to take 50 to 60,000 of losses a year. They
Mm.
came back, and that's when the active versus passive properties and rental property is considered passive unless you meet the real estate professional of the 750 hours.
Perfect. So ultimate there is talk to a good real estate professional. If you don't have one, call me. We'd love to help you. Have a good CPA like you. If you don't have one, call Jan. And make sure you understand the strategy behind why you're doing this and make sure how it's going to affect your taxes.
Right.
And if you still don't understand it and you want us on the same page, we will gladly talk and make sure we're achieving your goals. Is there anything that TikTok really has wrong on this topic? TikTok likes to talk about things and make jokes of things. What do they have wrong on this?
TikTok says you can write off 100% of the property. And as we said, you need to state that. You need to allow for land. And then you also need to split out the value of the property between true real estate components that will take 31 a half year to depreciate versus the fixtures, the appliances, the new flooring, carpets,
So
etc.
I do want to break that down just in case people still don't get that. So when we talk about a house, we have studs. The studs last for a while, right?
Exactly.
But that flooring and those cabinets and
Right.
that fridge, that wears
Yeah.
and tears. I mean, how often do we have to replace that?
Right.
And in a rental, even more often. So those appliances aren't going to last for 31 and a
No,
half
they're not.
years.
Not.
But those studs in the wall probably will,
Yes.
right?
Yes.
So when we do that cost segregation, that's what they're breaking down down to every nail in that house, every
Exactly.
doorknob, every handle, every light fixture, every fan, the electrical. How long is each thing going to last?
Right. And it's important too for commercial rentals because if you have a building that's a commercial property, not an individual property, the depreciation is 39 years.
Oh, wow. So commercial, it's actually 39
I
instead of
know.
31 and a half.
So it's very important that you get the cost segregation studies now to break down the cost of those furnitures, fixtures, appliances, etc.
Are there any other big surprises that we haven't talked about that people could run into with this?
No, just document, document, document. You need to have your log for your 750 hours. You need to make sure you document your mileage, allocate for a portion for land, and make sure a lot of times people don't get all their expenses in there. I can't tell you how many times a client comes in and says, "This is my real estate." And I'll go back and look and I'm like, "I don't see where you paid insurance this year." Oh, I paid. Make sure you have everything on there.
So, when we talk about this bonus depreciation, is this only for large investors? What if I've never bought an investment property? Could this strategy work for me?
Yes, exactly. Now, the investment property, remember, there's two types of investment properties. There's an investment property that you're the real estate professional, and so you can write off those up front versus an investment property, but you do not have the 750 hours. Those we need to keep in mind that you can only deduct $25,000 of expenses or losses per year, and those phase out at 150,000 income limit.
So, if you had someone who wanted to buy their first investment property this year, what advice would you give them?
What's your long-term goal? Is it to be an Airbnb, et cetera? That provides benefits because you make some more money, but it also has more wear and tear on the property. Versus if do you want to rent it to a single tenant monthly rental, et cetera?
I love that. You answered my question with a question. Do you know how many? That's what I do with my customers, and it drives them crazy. They
Yeah,
ask me a question, I have to ask three questions first. And the reason why is before I answer that question, I got to know what you're talking about. I got to know what
correct.
your goal is. And how can I answer that question accurately if I don't know which direction you're going? So I love that you actually ask questions instead of giving me a direct answer because you're right. You don't know what you're doing.
I have so many clients that come to me after the end of the year and are complaining about being a short-term rental, that the maintenance, the housekeeping, the towels, all of that, and I said, "Well, what about thinking of making this a long-term property?"
Mhm.
And several of them do because having a short-term property, if you don't have a good property manager, which you pay for the property manager,
20%.
and it gets to be a burden. So some of my clients have actually transferred into long-term, and that's
Mhm.
passive, but it's like they wanted the long-term investment and they wanted the value of real estate to increase, but they don't want the day-to-day
Yeah.
necessities of being.
So that poses a question for me. Let's say I buy a short-term rental now and I
Mhm.
do the 80% bonus depreciation on those things that are going to wear and tear through the cost segregation. And 3 years from now, I say, this is just not the work I want to put into this. Can I switch it to a long-term rental? And does that have a tax implication?
You really need to keep it at least 5 years.
Okay.
If you don't, there's a recapture percentage, and that recapture can be up to 25%.
Okay. So if I change my mind, there could be some tax obligation there.
Exactly.
So in 2020, 2021, 2022, short-term rental went through the roof because no one had to work, no one had to go to school,
Right.
and we were free in Florida. So everyone
Yeah,
came to Florida,
exactly.
right? And so term rental here became massive. All of a sudden, these regular neighborhoods that you never saw short-term rental in. We've always had good short-term rental near the beaches.
Right.
The tourism area and the way our towns are really set up here is the tourism's out there. It's out on the island, right?
Right.
It's not in our day-to-day life in the city, which makes it great for traffic. We get their tax dollars, but they don't interfere with our daily lives. But we saw all these residential neighborhoods just popping up with Airbnbs. And I kept telling my customers, they call me, hey, I need to buy short term rental, I need to buy short term rental. The advice I gave them was we have to be able to switch to long term immediately. And it makes sense. So we have to run it both ways because this short term rental is a temporary fix. This is going to go away. No one has to go to work or school right now. They're inflated numbers you're buying a property on. It may not do that next year. My other fear with it was, it's a new thing really in the history of
Mhm.
owning property. It's fairly new. And so there's not a lot of regulation around it. And now what we've seen is regulation starting to come. They're trying through zoning and things like that. We've seen as close as Fort Walton. One of the cases go all the way to the Florida Supreme Court. And luckily, I was smart enough to recommend to all my investors make sure we can switch this to short term or long term rental,
Correct.
the short term to long term at any given time, because when everyone else puts their Airbnbs on the market, you don't want to be on the market at the same time. And that's exactly what we saw there. I could go on right. That's fine.
Exactly.
Tons of
Neighborhoods, like in my neighborhood, I don't want a short-term rental next to me because the short-term rentals are for bachelorette parties, etc. And who wants to have people next to you when you're trying to go to work and
Right, but if you don't have an HOA, that's property
right,
rights. So
right.
we could really get into that because I
Okay.
love our property owners having rights, but in a HOA,
Yeah.
they have a way to
Right.
regulate that
Right.
and
Right.
things like that. And that's really what the state Supreme Court looked at and
Okay.
decided whether or not a property owner has the right to do with what they want.
Right.
I had one across the street from my house, and my husband hated it. I remember one day he walked out, was having his coffee in the morning and looking at the 20 cars parked up and down the road on everyone's grass. And he's like, I don't like this, like
Yeah.
the grumpy old man, right?
Right.
And I'm like, honey, it's their property rights. We got to support their property rights. And even though it's in our front yard,
Yeah.
we always have to look back. It's not just about what's affecting us today, it's in the greater scheme of
Right.
things. Do we want people telling us what to do on our property?
Right.
And he's like, you're right.
And also, I'm telling my clients when they look at investment property, look at it for the long range thing. It may be a house in a neighborhood that's got a great game room, great, etc., which it leads it to a short term rental house. But if you have to convert it to a long term rentals, is an individual going to want to pay that much for a big game room? The rent increase.
Exactly. Is it going to make sense for a
Right.
long term rental? And that's definitely what we make sure of. So let's talk about practical planning steps. So before someone goes out and actually buys a property, what do they need to do to make sure they're set up correctly?
First of all, they need to consult their bank and find out what the mortgage rates are going. They need to do the budget. Can they, if it requires cash flow out, because it's hard when you first buy a property, it's not going to cash flow immediately. It's going to take you a couple of months to build it up, etc. And can they afford that, the incidental repairs, etc. You need to make sure it makes sense in your budget.
And what should they be asking or telling their CPA throughout the year versus waiting until the end of the year?
They should tell their CPA what they're planning to do. You should sit down with your CPA when you do your taxes. And I like my clients, a lot of my clients just drop off their taxes or email them to me. I like them to say, what are your goals for next year? What are you going to be doing?
And they don't like to do like me and just call, hey, I just found a property I want to buy. What should I do?
Yeah,
And how
right,
should I set it up
right.
last minute?
And the worst thing they can do is, let's say they buy a property and it's one of these passive properties and they are over the income limit. So they thought they were going to get these great business deductions and they cannot deduct any of it.
Right. So definitely hey, give them a call. Say, hey, this is what I'm going to do. Should I? Shouldn't I? What do I need to think about?
Correct.
So, what we talked about tracking their time, if they're going to identify as a real estate professional, what else should they be tracking to maximize their deductions?
All your deductions. Get a credit card or something, and you put all your rental expenses on that. Don't put them. Don't. I like my clients to have two separate credit cards. This is for household expenses, etc., and this one's for the rental. So then, when they're going through at the end of the year calculating their numbers for me, they know that all of these expenses are on this one card relates to the real estate.
And don't forget that mileage.
We deduct a small portion of your tax prep. If you have to talk to an attorney, those are deductible. Assessments, everything. A lot of times, if a condo does a big assessment, so many times I've got my taxes done for a client. I say, you owe this much. And they're like, oh, let me go back and look. And then they paid a $20,000 assessment, which is a current deduction.
Yes. Don't forget that. That's a huge one. So, what is the biggest advantage of bonus depreciation that most people are going to overlook?
The bonus depreciation, you can, as I said, the write off of the cost segregation study, writing off the portion of the cabinets, the appliances, the flooring, etc., and you get an 80% deduction up front.
So, taking that 80% of those diminishing items this year.
Correct.
What is the biggest risk with doing this?
The biggest risk is documentation. Because if you're not one of these real estate professionals, or if you don't document correctly, and let's say you have a investment property on the beach and you're going to use it you're allowed to use it for 14 days.
Mm-hmm.
You're also allowed to do is when you're in there, let's say you decide to paint it. Those are not considered your rental days, personal days. Those are considered repair days. You need to document your calendar.
So I went out there and did these repairs. I didn't just go on a family vacation.
Right.
And so, last question, just to wrap this up, what is one piece of advice that you would give someone who's really trying to build wealth through real estate? What's your best advice for them?
See Jessica for
Well,
great
thank you.
properties and talk to your CPA because you can build good wealth for the future, but you got to do it carefully and planning and make sure you're not overextending yourself.
I think that's great advice. And it really does take a team of all of us working together and making sure we are helping them achieve their goals, from the lender to the insurance agent to the CPA to me as the real estate agent. We really work together to help people achieve those goals. And I love when people are upfront and honest with me of what's going on and what they're trying to achieve, because I can help them so much better.
Correct.
Sometimes people are a little hesitant to tell me their goals right away. And once they finally break down and do, I
Right.
can help them so much more. Thank you so much, Jan, for being on the show. It is always a pleasure to talk with you about the stuff I love to geek out about, taxes of all things. Thank you so much for being on the show, and we hope to have you on the show again. I would love to talk about something. Love to have you on the show, and let's talk about using a self-funded IRA for real
Okay.
estate. Can we do that in
Great.
the
Yes.
future?
That's
I would love that.
Thank
Awesome.
you for having me. And if anybody has additional questions, please just email or contact Jessica and she will get them to me.
Yeah, and all your info will
Uh-huh.
be in the show notes, so
Yeah.
people can reach out to you if you need a good CPA. I strongly recommend her. Like I said on the last episode, before I hired her, I interviewed about 8 or 9 people, very direct questions, and she impressed me so much. I knew her actually before then, and I didn't want her to do my taxes because I knew her. And, that's like standing in front of someone naked. Yeah. So I was like, "Eh." And then I interviewed 8 or 9 people, and I was so blown away by your answers. I was like, she has to be my CPA. So thank you so much again for being on the
I've
show.
enjoyed it.
We hope you loved the episode today. If you have, make sure you like, follow, or subscribe no matter where you're listening to, so you never miss an episode. If you have a question or a show topic, please make sure you DM me, email me, Facebook me, however, just get it to me. I might just ask you to be on the show. Thank you so much for listening. Remember, this is Jessica Duncan, and it's just my opinion for adulting made simple.